This is Catherine Morgan-Nance with a review of variable costing. Thanks for watching. This presentation is split into 4 parts for your convenience. Part 1 provides a brief overview of variable costing concepts. In Part 2, we will review 2 absorption costing examples. In Part 3, we'll employ variable costing in 2 more examples and do a little compare-contrast. And in Part 4, we'll consider the impact of the costing methods over multiple years, as well as summarize some other considerations. Let's get started with Part 1. 2 general approaches are used for valuing inventories and cost of goods sold. One approach, called absorption costing, is generally used for external reporting purposes. I mean GAAP, generally accepted accounting principles here. Absorption costing treats all manufacturing costs as product cost. An issue of absorption costing is that it allows income to rise as production rises. Under the absorption cost method, management can push forward costs, defer them to the next period when the products are sold. This artificially inflates profits in the period of production by reporting lower expenses than would be reported using a variable costing system. The second approach, called variable costing, addresses this issue. Variable costing is a managerial accounting cost concept that treats only those costs of production that vary with output as product costs. Variable costing recognizes that fixed costs don't change with changes in volume, while variable costs do. Under this method, fixed manufacturing overhead is reported as a period expense. This approach dovetails with the contribution approach income statement and supports CVP, cost volume profit, analysis because of its emphasis on separating variable and fixed cost. Some managers prefer to use variable costing to evaluate performance because it's easier to see the impact of pricing decisions and volume on profits. This video series shows how absorption and variable costing methods differ from one another. Let's briefly discuss then the 2 styles of income statements we'll be using in the upcoming examples. Absorption costing uses the traditional income statement. On the left, it organizes costs in a functional format by whether they are product or period costs. Costs relating to production, administration, and sales are grouped together without regard to their cost behavior. The traditional format is used primarily for external reporting purposes. On the other hand, variable costing uses the contribution income statement on the right. The contribution format organizes costs based on cost behavior. This format emphasizes cost behavior by separating cost into fixed and variable categories. Contribution margin is defined as how much is left of a sales dollar to cover fixed costs and provide for income. The contribution format is often used internally as a tool to enable CVP, cost volume profit, analysis, and to make pricing decisions. So what is variable costing and how does it compare to absorption costing? This slide contains a lot of information, but it's a great summary for learning the concepts in this section. I recommend you keep it handy for reference during our discussion. Under absorption costing, all manufacturing costs are included in the cost of inventory produced. They're a product cost, regardless of whether their behavior is variable or fixed. Under this method, the cost of a unit produced consists of direct materials, direct labor, and both variable and fixed manufacturing overhead. For a company's financial statements to be presented in accordance with GAAP, with generally accepted accounting principles, the company must use the absorption costing method for valuing inventory. Now, under variable costing, only variable manufacturing costs are included in product cost. Those would be direct materials, direct labor, and variable manufacturing overhead. Fixed manufacturing overheads are treated differently. They're accounted for as period costs, which means they're expensed in the period in which they're incurred, just like selling and administrative costs are. Now, this is how variable costing gets its name. Product costs include only variable manufacturing costs. The variable costing method is used for internal purposes only, and it's valuable because under the method, changes in inventory levels do not affect net income. This is the primary benefit of variable costing. Variable costing makes it easier to make pricing and other product-related decisions because it's easier to understand which costs are subject to changes in volume and which costs will not change in total. Those are the fixed costs. Variable costing may be used to evaluate the performance of managers, products, and divisions. And finally, please note that under both methods, selling and administrative costs are accounted for as period costs. They are always expensed on the income statement in the period they are incurred. In the next video, we'll look at a couple of absorption costing examples before moving on to variable costing. See you soon.